day everyone, thank you for joining me. I'm Tamara Kukshinovich and I'm going to take you through the Home Depot EIA. In February, Home Depot released FY20 results and the highlights were as follows. Revenue rose 19.9% to $132.1 billion and 19.7% on a comparable basis. Gross profit increased 19.4% to $44.9 billion and gross profit margin decreased from 34.1% to 34%. Operating profit accelerated 15.4% to $18.3 billion and the operating profit margin fell from 14.4% to 13.8%. Net income increased 14.4% to $12.9 billion. Diluted EPS grew 16.5% to $11.94. Dividends per share rose 10.3% to $6. The group recorded a beat on market expectations across the board. Following the FY20 result in February, the share decreased 8.6% while the benchmark was up 0.1%. Over the past year, the share outperformed the Dow Jones Global Titans 50 index, returning 47.5%, and the index 41.31%. Year to date, the share outperformed the index with a return of 21.6%, while the benchmark returned 9.1%. On a forward PE basis, the share now trades at 24.5 times, a 19.6% premium to its historical average, and a 12.9% discount to its FactSet peers. Home Depot is the lead retailer focusing on home improvement, which also has a large contractor supply business. The company poses a barrier to entry for competitors as it is located in over 2,200 places and its online channel is growing rapidly. In other words, smaller competitors trying to enter the space would struggle to duplicate Home Depot's benefits in logistics and vendor relationships while keeping prices reasonable. However, competition is increasing due to the growth of e-commerce. A company like Amazon will easily overcome these hurdles. Positively, Home Depot has a strong brand and a large store footprint, enabling support from its target market. Competitive moat is created through the destination stores for contractors and DIY clients, as well as the expansion of its online channel, which is supporting the high sales performance in the changing retail landscape. The group has invested largely to boost supply chain and improve the digital experience for consumers through its One Home Depot initiative, creating an interconnected retail experience. This has proven to work, with online sales increasing 86% and 60% of orders are picked up in store. Additionally, the group acquired HD Supply, a leading national distributor of maintenance, repair and operations products in the multifamily and hospitality markets. This will further drive growth. The company has a dividend yield of 2%, paying out 50% of its earnings, which provides stable income together with momentum. What we like about Home Depot is the high and sustainable dividend yield relative to peers, its strong balance sheet, its wide economic moat, and the fact that it may be less likely to be disrupted by innovation. The FY20 results were solid, however, we can expect growth to decline as consumers shift their spending from home improvements to entertainment, travel, and other activities restricted due to COVID-19. Consequently, the company may face some short-term weakness, but we believe the share will succeed in the long term. This is proven by the upward trend of transaction counts and the ticket size before the pandemic. DIY was the best performer in the past year, with Do It For Me showing accelerated growth too. Therefore, if DIY sales were to fall as restrictions are lifted, Do It For Me may offset this. We believe this is a solid business and it should continue to show growth in sales and profits. So we recommend a neutral position for the PSG Wealth House.